and thanks for joining us for another APW market update. I'm joined again by Dr. Steve Garth. And Steve, the news headlines for March have been dominated by the Middle Eastern conflict, which is expanded into a global oil crisis.
That's right, Jeff. It's great to be here, but you're absolutely right. There's really only one thing to talk about this quarter, and that's the effect that the conflict in the Middle East has had on oil and inflation.
We will see as we get through this discussion that markets have been amazing in terms of their resilience, and it's certainly been an up again, down again every other day as new information comes to light. Perhaps we start with what oil's been up to.
Yeah, so oil is the big story, and you can see in the chart here, Jeff, that oil has jumped nearly 80% since that conflict started at the end of February. Now, of course, everyone's feeling this. Normally when there's market volatility, you don't really feel it unless you're watching the market every day. But this time, we're all feeling the effects of this conflict because it's right here at the petrol.
At the barrel, yeah.
So it's very real. So oil up, but of course oil is not just petrol, it's also energy that we're going to use for heating and just about everything in the economy. So an extraordinary jump up in there because of the conflict and the closure of the Strait of Hormuz.
In the Aussie market though, again, as I say, financial markets have held up reasonably well. In the Aussie market, let's have a look at how it's performed over the March quarter, dominated by the month of March and the impact in the Middle East.
Yes, Jeff. Well, in the chart that we're showing here, we've got the Australian stock market, the ASX 200. It's a wobbly line. It was down at the start with the tariffs, and then it's had a pretty good run since then until the end of February, where you can see it's gone down. So while it feels that markets are in a really volatile state, they're not as volatile as you might think. And that's reflected in what's happening to the share price. So yes, the markets are down, and the Australian market is down minus 1.6%. Now, negative numbers are never good. Sure. But minus 1.6% is a small number. And when I look at the number over the prior 12 months, we're up 11.7%. That's a really strong annual return.
Let's have a look at the US now, let's look at global markets. The US being, of course, the major one, and see how the Aussie market compares.
Yes, well, no surprise. Markets around the world are down for the quarter, as you can see in this chart, but up positive for the 12 months. Now, the developed market index, we're showing that on the left-hand side, it's down 6%, but that's because most of that, or 70% of that, is the US, which is down by 7%. It's the one that's most down. But other markets, other big markets and developed markets are Europe and Japan, also negative, but not as bad. So results are mixed. And the emerging markets down a little bit, but look at that annual return up, 17.8% for the year.
And then, of course, the other side of the coin is bond markets. Maybe we look firstly at interest rates and compare those, particularly the US and Australian interest rates, central bank interest rates, how they're moving.
So what had been happening is the US central bank had been cutting rates, and until the conflict escalated, the market was expecting the Federal Reserve to cut rates again, but in their March meeting, given the conflict had escalated, they left rates on hold. In Australia, the rate rises that happened in both February and March were sort of expected by the market because our inflation had crept up in the last quarter of last year.
Yes, well, it wasn't that long ago that the expectation would be for a number of rate cuts here in Australia through 2026. Things change very quickly.
One way to graphically show this is through 10-year bond yields. Now, normally no one's got any interest in 10-year bond yields, but they are a predictor for what might be happening economically down the track, both in terms of interest rates. And when I show this chart, you can certainly see that back in the last quarter, 10-year yields in Australia jumped up. That was because, as I mentioned, we had much stronger inflation already. So again, the RBA was always destined to raise rates this year. But you can see in the chart that both Australia and the US, those yields have bounced just in the last month because of that conflict. So there's a tug of war going on here. Yields go up when inflation goes up, but you might expect that bond yields to go down. In other words, there's a flight to quality when there's a geopolitical conflict. So that's the tug of war going on at the moment, to which inflation's winning.
So there's plenty out there happening, and it just reminds us the importance to be well diversified in the portfolios. And we can, I guess the other thing to keep in mind is, the media talks about share prices have come down, but every asset has to be owned by somebody. So if someone's selling, someone else is buying.
So every seller has got to be a buyer.
Indeed. All right, well look, that's been very, very useful, and hopefully we've got some better news to talk about in the next quarter as well, although that's pretty good news that we've got at this point.
It's not as bad as what people might be thinking, given what we're seeing in the media about the volatility.
Thanks again, Steve. And thank you for watching, and we look forward to seeing you at the next webinar. Bye for now.